5 mistakes that you can make as a newbie investor. Number 1, not investing in equities. Yes, it's higher risk, but it also reaps higher returns. I started investing as soon as I started earning. And in India, you're forced to invest if you want to save taxes and all those tax saving instruments. I invested only in mutual funds and I did not invest in equities because equities are considered to be high risk. And they say that you should diversify. And the best way to diversify is through mutual funds. It's been almost 10 years. And when I looked at the mutual funds and how they have performed in the last 10 years, I realized that the XIRR, which is the way you would calculate the annualized returns for the past 10 years, was somewhere between 10 to 12% only. Not bad, but it isn't really great either. You don't build wealth by getting 12% returns on your investment. If you are aiming to generate good returns from your investment, then you need to aim high. When you are in your 20s or even in your 30s, you can take higher risks. Yes, equities are higher risks, but if you make calculated bets, then your risk comes down significantly. Mistake number 2, no understanding of the fundamentals of a company or a stock that you're purchasing. If you invest in equities, but you haven't had any formal education or training or understanding of the fundamentals of a stock or a company, then you would make a lot of mistakes. So if you're someone who Googles top mutual funds to invest or top US stocks to buy right now, you are no better than your parents who were taking advice from a 20-year-old broker. Instead, you are just relying on the online community. Spend 30 minutes to educate yourself, understand how to read a company's financials. It's not that difficult. Here's a video and you can find a link down in the description. By developing a very solid understanding of these fundamental principles, you would be able to analyze stocks for yourself and not rely on anyone else. You also do not need to then settle on mutual funds for mediocre gains, right? Mistake number 3, diversified way too much. I once invested in over 40 to 50 mutual funds to diversify my portfolio and maximize returns. What I didn't realize was I was choosing mutual funds just like I was shopping for clothes without really understanding what that over diversification could do to my portfolio and to my profitability on those investments. It's a simple risk return trade off. When you diversify, your risks go down, but your returns go down as well. So have a think of what your strategy is. Is it to save taxes, higher growth, or both, right? You need to consider your strategy. What's the point of investing in blue chip mutual funds and index funds at the same time? It doesn't make sense. Blue chip funds are expensive. It costs you roughly 2 to 2.5% of your investment value year on year, whereas index funds are cheap and provides almost similar returns. So do keep that in mind when you're investing. Mistake number 4, not monitoring your portfolio. It's just as important to monitor your portfolio as it is to invest in the right assets upfront. It's okay to make mistakes. It is okay to make losses, but it is not okay to sit on those losses and do nothing. You need to cut your losses by selling the stock if you don't believe the stock will do well in the future. If the losses are due to a temporary correction in the market, that's all right. You can wait. And if the fundamentals are strong, then you don't need to sell it. Not just your investments, but you also need to monitor all your assets. So your savings accounts, do you have some additional cash sitting there that you can invest? Your credit card accounts, did you fail to notice some bizarre transactions that have been made on your accounts just because you didn't look at your statements? Your retirement funds, are you making interest on your retirement funds, or are you losing year on year because of some bad strategy deployed by the retirement fund that you've chosen? Or even your property investments, are you making enough rental income out of them, or are you spending a lot more on maintenance of it? You do need to monitor how your assets are performing and if you need to rebalance your portfolio more often than you think you need to. How you can do that? My honest answer would be just simply open an Excel spreadsheet and start putting down all the data points. Mistake number 5, investing too little. Investing too little is almost like investing nothing. If you had an amazing opportunity, but you only invested a very small amount, that really is as good as nothing. So if you're buying a stock, then at least buy 3 to 5% of your total investment. That will ensure that you are getting enough money or bang for your buck, as they say, right?